Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. If you remember, last night I pointed out that I was expecting a pullback to that $34 price. We got that and a little bit below. You can see we got down to about $33.82. The big question is going to be, is this going to be a rolling over situation, or are we going to have another blast off? I really am not going to make any predictions at this point. I would say it's about 50-50. Now you can see the MACD is just getting down to, last night we were all the way up here. We're just getting down to about the point where all of our other rallies happened. We had a big rally here, a rally there, a rally there. Will we have a rally here? Now I've drawn a line from the lowest point on the 1 hour, which actually goes all the way back to July 30, actually August 1st. So we're looking at an oversold indicator that may rival the lowest we've been. Now, when these things flip over, they go much lower. So this could roll over and go much lower, and you can see that as you pull out. The way it works is as you pull out in the time frame, this is out to the 2 hour, you can see we're just approaching the 0 line. We're not as low. And then if we pull out further to the 4 hour, we're just rolling over, etc. So as you pull out, you can see those things. The question is, are we in that bull phase, and will it reset fairly rapidly? You can see that the correction to the trend line is going to take us back again, depending on whether we correct through time, is going to take us back to that 34 price. So that's a big question. Are we going to roll over at this point, or are we going to continue on and test this area in here? Now gold as well is showing a similar sort of thing, but more of a stair-step formation. Let's get to the gold 1 hour. You can see that gold is actually stronger as far as not correcting back to this price level, and is more oversold, has actually corrected below all of these. So we could see an explosive rally from here. That's quite possible. And then of course that's going to be another moonshot in the price, one if it is a trend channel change, then it's actually going to take us outside of this existing trend channel, and it's going to blast up higher, creating a new trend channel. So something is coming very soon, within the next couple of days, which is going to be a resolution rollover to the downside, or a bounce off of support and then another rally. We'll just have to wait and see on that. Now I wanted to go over to, well, before I go over to the questions of the night, I wanted to take a quick look at the oil chart, because that was a big story on Yahoo, that oil had sold off dramatically. You can see it's already corrected 50% of that sell-off. The sell-off was from above 100, actually about 150 cents, down to 95. That's about a 5% sell-off, so that is a fairly significant sell-off, but you can see that the MACD has completely corrected all the way back to June levels. So this may be a fake out. One thing that would be interesting to look at would be a overlay of silver and the oil price, because normally when one takes off, the other follows. So you can see silver is just edging over here while oil has dropped off. Will silver dramatically follow it down, or will oil bounce all the way back up and follow silver up? They're probably going to join back together again at some point, and that's probably going to happen in the next couple of days. Now over to the questions of the night. We'll start with silver, sure to go up, but what about everything else? This is from Slarty Bartfast. Hi, Brother John. Watched your recent Office series about the price of silver going through the roof. I read When Money Dies by Adam Ferguson a year or so ago, and it inspired me to do some of my own math on the Weimar hyperinflation as regards to precious metals. I used what published data I could find and used curve fitting in Excel to see what gold and silver might go to. Interestingly, if the dollar followed the path the mark took from January of 1919 to November 1923, we could see silver go up to $543 trillion an ounce. Gold could hit 87 quadrillion an ounce, but those numbers mean nothing unless you relate them to the economy in which it existed. For example, when gold and silver hit those astronomical highs, gas for your car would likely run 8 trillion a gallon, a loaf of bread would be 200 trillion. The one interesting thing I noted from the graphs was that precious metals do seem to front-run the trend during a hyperinflation. In other words, they accelerate in value significantly more quickly than more mundane commodities, but they do eventually settle into something close to the relative value against commodities that they had before the hyperinflation began. Of course, all this assumes we will have an event similar to the Weimar collapse. Our event could be very different. Isn't quoting the price of silver in dollars not meaningful if you can't also predict the relative price of commodities like gas, bread, rent, etc.? By the way, I'm an ardent stacker. There's a wonderful anecdote in Ferguson's book. He tells of a German lady who kept her family alive for 5 years right through the Weimar hyperinflation because she owned a single heavy gold chain. She took one leak at a time to the bank and traded it for currency. That one gold chain fed, clothed, and housed her and her family for 5 years. That's a very good example of how metals front-run the hyperinflationary wave and can be a very useful tool if you don't hold on to them for too long during such an economic disaster. So, interesting question. I would say anecdotally, one of the stories that I have heard as well was that there was a waiter or waitress during the hyperinflation who took a tip from an American that apparently was a gold coin, I believe it was, and ultimately ended up buying the entire building that contained the business that this person was working in. And that gets to the main issue here, and that is that people frequently ask this, well, does it really matter because the price of bread and the price of milk and everything else is going to be astronomical? Well, it does matter if you have debts because your debts are denominated in dollars. So I've always recommended that people keep a balance of cash and debts. A lot of people have talked about how you should have all your debts paid off and you should only stack gold and silver. I'm not going to question those people, Dave Ramsey and people like that, but if you are expecting some type of Weimar hyperinflation, then it may be in your interest to actually have dollar-denominated debts, such as your house. If you have a house that's at a very low interest rate, say you have a house with a 30-year mortgage of 4%, why would you go ahead and pay off that house? You may be able to pay that house off with just a couple of coins in the future. That is presuming that they don't change the rules in the middle of the game, and they've been known to do that, but it's quite possible that many of us with dollar-denominated debts, if we get this Weimar hyperinflation, will be able to pay off those debts, own the real property for pennies on the dollar. So, very interesting speculation. We're going to have to wait and see what happens in the future because no one really knows which path they're going to choose. Next question is Peruvian currency. How well is this currency and will they see turmoil like the USA? Thank you, Brother John. So let's go and check that. I actually haven't checked that. You just go to cross rates and you can check that on NetDania, and it's called the Peruvian Nuevo Sol, New Sun, I guess that would be, and we'll check the US dollar figure and go out to the daily. So this is the US dollar versus the Peruvian currency, and if I'm reading this correctly, it looks like it's taking less and less dollars to buy this currency. So that would mean that this currency is falling in value against the US dollar. That's pretty common. if you look at the Mexican peso, it's a similar sort of story. The Mexican peso has continuously lost value against the US dollar. It's one of those stories of which is the worst amongst all of the bad, because all the currencies, of course, are bad. And the question is, which is the worst? You can see on the MACD here for the Mexican peso, we're actually rolling over, and we're in a trend now where the peso is increasing in value. Those travelers who traveled after the collapse, you can see that the peso went from about 10 pesos to the dollar all the way up to 15 pesos to the dollar. We're now about halfway from that. So people who had a lot of money to spend made out very well traveling to Mexico. So that's a difficult question, especially when you're talking about the Central and South American currencies. They're just very hard to predict. And the last question we're going to talk about, and that's going to take us to the main story of the night, and this is from Web City USA. Here is a must-read analysis of QE3 by accountant Daniel R. Ammerman entitled Unlimited QE3 Quick Analysis, Federal Reserve Attacks U.S. Dollar, Risks Currency Warfare. And he suggests that I read that article. Now, I'm going to go ahead and review that article. But before I do that, I wanted to point out my original video on financial repression over a year ago. And that is where I reviewed the Sheep Shearing Instruction Manual by Daniel Ammerman. And I also include an analysis of this theory of financial repression and what it means, the 4 aspects of it. I'm not going to go over that now. I'm going to link this, and if you want to watch that video, it's a long analysis of financial repression and what that is. So let's read the latest from Daniel Ammerman, and this is Unlimited QE3 Quick Analysis, Federal Reserve Attacks U.S. Dollar, Risks Currency Warfare. Now, you know from my video about Ben Bernanke being public enemy #1, one of the reasons why I titled that video what I did is because of the damage that Bernanke is doing to retirees and those on fixed incomes, and then of course the poor. The people that he's benefiting are the 1%, or even the 1% of the 1%, because actually I think 99% of the 1% are really going to be wiped out in what's coming, but 1% of that 1% will be made much wealthier. But let's read this. This is, again, Daniel Ammerman, QE3 summary. The Federal Reserve has just announced that it would launch the so-called QE3, or Quantitative Easing 3 program. Key components are: 1, the creation of $40 billion a month out of thin air to purchase agency mortgage-backed securities at artificially low interest rates. 2, the continuation of Twist 2 and the shifting of Federal Reserve holdings of U.S. Treasury bonds into longer-term bonds. 3, combined purchases of long-term securities between QE3 and Twist 2 of approximately $85 billion per month through the end of the year. 4, quantitative easing without any predefined limit, meaning an open-ended commitment to keep purchasing securities at whatever level is judged necessary until the labor market improves substantially. 5, the potential purchase of additional assets and the deployment of other policy tools as needed. And 6, an extension of the 0 to 0.25% target range for the Fed funds rate until at least mid-2015. That is 3 years from now. And here's a link to this statement. Analysis. No sterilization means radically increased inflationary danger. The most important part of the Fed statement was the word that wasn't mentioned: sterilization. This means that there was no promise to contain the newly created money, as was the case with QE1 and previous mortgage security purchases, but instead it appears that the newly created money will be going directly into the economy and on a potentially unlimited basis. The promise to create money out of thin air and inject it into the economy at a rate of $40 billion a month on an unlimited basis is the single most inflationary act the Federal Reserve has taken to date. While the dollar volume on a monthly basis is somewhat less than prior easings, aka monetary creations, the non-sterilized and potentially multi-year nature of QE3 takes it to an entirely different level than QE1, QE2, or the twists. For a background reading on how sterilization works and why central banks usually sterilize, there are several articles in my Money Creation Primer linked below. Analysis. An attack on unemployment through an attack on the dollar. The Federal Reserve is indeed using QE3 to attack the problem of unemployment, but not through the method stated. The cover story is that QE3 will be used to increase the money available for lending and to lower interest rates. It is a credit to Mr. Bernanke that he was able to read this statement with a straight face, for the assertion that the economy is being held down by too high interest rates and tight money is ludicrous. Interest rates are already at historic lows, and banks are awash in available cash. Moreover, QE3 is likely to have very little effect when it comes to expanding corporate lending, just as QE2 had very little effect, because that was never the intended route to rebooting employment in the United States. As described in detail in my article, Bullets in the Back, How Boomers and Retirees Will Become Bailout, Stimulus, and Currency War Casualties, linked below, the United States has a structural problem with unemployment that is essentially unsolvable so long as the dollar remains high in value relative to other global currencies. This problem was exacerbated by the rise in the U.S. dollar caused by the euro crisis, and it's no coincidence that the unemployment crisis in the United States is now getting rapidly worse, even as the dollar soared this past spring and summer. The Federal Reserve is, of course, well aware that unemployment situation is far, far worse than what is being captured in the official headline unemployment rate of 8.1%. The government knows full well that the true unemployment rate, once workforce participation rate manipulations are netted out, is close to 19% and getting worse, as explored in detail in my article linked below, Making 9 Million Jobless Vanish, How the Government Manipulates Unemployment Statistics. This building crisis of strengthening dollar and rising unemployment called for emergency action, and that is exactly what Bernanke is doing. He is effectively calling in a B-52 strike on the U.S. dollar, monetizing for the world to see, and pledging to monetize for as long as it takes until the U.S. dollar is driven down to a level where American workers can once again be globally competitive. Well, I would say good luck with that. If the rest of the world sits back and the U.S. drives down the value of the dollar, then U.S. employment is indeed likely to rise at the cost of falling employment elsewhere. But if the rest of the world is not willing to sit back and watch jobs flow to the U.S., then there's a likelihood of counterstrikes and even the danger of all-out currency warfare. Analysis: increased financial repression, increased hidden taxes, and a devastating blow to retirement investors. Consider two promises the Federal Reserve just made. One, that it will create money out of thin air on a massive scale for as long as it takes until substantial improvements in the labor market occur. And two, that near zero short-term interest rates will continue until at least mid-2015, even as interventions in the long-term bond market will also hold long-term interest rates down. In other words, inflation goes up, whether officially captured in inflation statistics or not, and interest rates are forced even lower for a longer period of time. There is a term economists use for this process: financial repression. As I explained in detail in my article, Financial Repression, a Sheep Shearing Instruction Manual, linked below. Financial repression is a strategy deployed by the governments with large debts, which involves deliberately creating rates of inflation that are higher than interest rates, and in the process taking wealth on a wholesale basis from individual savers across the nation. It has been used by many nations over the decades because it works, and the Federal Reserve has just kicked financial repression into overdrive with QE3. Now, I don't have enough time to finish this, but I encourage you to read this article. And as I pointed out in my Public Enemy #1, Bernanke has declared war on retirees. He's declared war on the poor. He is clearly a friend of the bankers. He's an enemy of the people. And it couldn't be clearer than that. So I encourage you to read this article. Last thing I'm going to cover is an investment that I want to encourage you to look at. And that is something that's going to be here on eBay. I just did a simple search for gold plated, and it's under coins and paper money, and then I just did a best match. But you can see here there's a 24 karat gold plated quarter. Here's an Indian head that's you can see $2.75. And here's a bicentennial set. If you go down, you can find a lot of stuff here. There's some coin collections here, a collection of quarters. There's other collections, and here's a very interesting dragon design. And I found that earlier also with a silver plated. And so I encourage you to increase your gold plated collection. Here, these aren't buffalo nickels, but they're nickels. I'm sure you can find gold-plated buffalo nickels. You can probably find gold-plated gold eagles as well. And now, a lot of people are going to ask me, why are you encouraging this? Well, here's the Yonkwin one. This is a very good one here. I like this one a lot. But why are you encouraging this? Well, the reason why is because you probably want to have a decent collection of gold-plated coins. You may be someone who has a lot of gold or a lot of silver and a lot of places that you keep it, and you might want to keep in the most obvious places, you might want to keep a lot of gold-plated stuff, and you can think of the reasons why. So back to the silver chart. We are waiting to see if we rally higher in this correction phase that I predicted. $34 is going to be the test line here, and if this bull pattern holds, we're going to bounce off that and rise dramatically. We may create a new trend channel, or we may actually continue in this existing trend channel and just slowly go up and test that 37.50 level. If I'm wrong and we roll over, we're going to see a breakdown in this MACD, and we're going to be setting short-term new lows in the MACD, and that will put us into an oversold position unless we get some kind of dramatic news that causes a violent sell-off, which the oil market seems to be hinting at. We don't know, but that may be the case. So we will wait and see. It will clearly define itself in the rest of this week, and we'll talk to you next time.